All right, let's dive in. Today, we are going to dissect one of the most comprehensive financial studies ever conducted. We're talking about nearly a full century of the U.S. stock market, looking at the complete history of over 29,000 companies to really uncover the true nature of how wealth is actually created. And let me tell you, some of the findings are pretty surprising.
So here's the big question we're trying to answer. Does picking individual stocks reliably build wealth? Now, the data shows that it certainly can, but, and this is a big but, it comes with a critical warning that every single investor needs to understand. The reality of the market is just far more skewed than most people ever realize.
Okay, so before we get into the weeds, let's start with the big picture. And you know what? The big picture looks fantastic. As a whole, the U.S. stock market has been an absolutely unparalleled machine for creating wealth. And when I say it looks fantastic, I mean the scale of the difference here is just staggering. Over this entire period, a portfolio that held the entire stock market, reinvesting all the dividends, just massively outperformed the safest alternative you can think of, one-month Treasury bonds. You want to put a number on that outperformance? The market's total compound return was over 1.5 million%. That works out to an annualized return of 10.1% for a full century. It's just an incredible testament to the long-term power of compounding.
So what does that mean in actual dollars? We're talking about nearly $91 trillion in wealth created for shareholders. And get this, that's the net wealth after you account for what they would have earned in those risk-free T-bills anyway. It's truly an unprecedented economic achievement.
But, and this is a huge but, as your analyst, it's my job to look behind that impressive aggregate number. Because that $91 trillion figure, it hides a very different and frankly, a pretty hostile reality for the investor who isn't diversified, the person who bets on individual companies. And here is the critical distinction. While the average lifetime return of a single stock was an incredible 30,000%, the median stock, the typical one right in the middle, it actually lost money. This is because of something called positive skewness. A tiny number of superstar stocks generate such massive gains that they pull the entire average way up, completely masking the fact that the majority of stocks don't do well at all. In fact, let's set the bar at the absolute minimum for any risky investment. All we wanted to do is beat the safest government bonds. Well, the results are pretty startling. Nearly 60% of all individual stocks that have ever traded in the U.S. actually destroyed wealth compared to just holding T-bonds. And this all leads us to the single most important finding of our entire analysis, a concept that is absolutely vital for every single portfolio, the extreme concentration of wealth creation. Remember, our team analyzed the complete history of all 29,081 firms that have listed on the U.S. public markets over the past 100 years. Every single one. And when you rank them by how they performed, a really stark mathematical reality just jumps right out.
So let's break it down. You take the worst performing firms, that's the bottom 17,197 companies, and together they collectively vaporized over $10 trillion of investor wealth relative to T-bills. Just gone.
Okay, so what about the next group up, the kinda middle-of-the-road companies? Well, it took nearly 11,000 of them to generate just enough wealth to precisely cancel out the massive losses from that bottom group. I want you to stop and think about what that means. When you add those two groups together, you've got the vast majority of all public companies, over 27,000 of them, or 96% of the total, and they created zero net wealth for investors. Zilch. Their collective performance was no better than just holding risk-free bonds. So if 96% of companies created nothing, where in the world did that $91 trillion come from? Well, here's your answer. The entirety of the market's gain, every single dollar of that net wealth, was generated by just 1,082 elite performing companies.
This really reveals the brutal math of the market. All of its success, the entire $91 trillion prize, came from less than 4% of all companies that have ever existed. Less than 4 out of 100.
And it gets even crazier when you look at the very top of that elite group. The concentration becomes even more extreme. Just 46 firms account for half of all the wealth ever created. Only 8 firms account for a quarter of it. And just 2 firms, are responsible for 10% of all net wealth generated in the last century.
And this slide right here shows you the modern face of that concentration. You see the familiar names, Apple, Nvidia, Microsoft, they're sitting right at the top, each one responsible for creating trillions of dollars. To put that in perspective, Apple alone accounts for over 5% of all net wealth created in the market's entire history. That's just wild.
So, what do we do with all this? After reviewing a century of hard data, what is the clear conclusion? How do you actually position a portfolio to capture these highly concentrated gains?
Well, the data proves unequivocally that trying to pick those few winning stocks, trying to find the needle in the haystack, is statistically a losing game. You are betting against overwhelming odds. The only proven strategy to ensure you actually own the future winners is broad, comprehensive diversification. It's about buying the entire haystack.
The takeaways here are definitive. First, a strict, disciplined diversification strategy is absolutely essential if you want to capture the market's returns. It's non-negotiable. And second, you have to combine that with the discipline to remain invested for the long term. That's how you ensure you're in the market to own the future mega winners, wherever they may come from.
The historical record is crystal clear. The winners of tomorrow will almost certainly be a tiny, tiny fraction of the total market. So the question I leave you with is this. Is your portfolio designed to capture those winners? As your advisors, we are dedicated to applying these centennial lessons to structure your portfolio for success and to safeguard your capital. Thank you for your attention.